If oil prices continue to climb, the global economy will start feeling the effects in many ways, from transportation costs to inflation to electricity prices. But in markets like the Philippines, rising energy prices don't only create risks, they also create opportunities. Today we're going to look at 10 Philippine stocks that could potentially benefit if oil prices remain elevated. This is not about hype, it's about understanding how higher energy prices flow through the economy and which companies could see stronger revenues, cash flows, or pricing power because of it. Let's start with the first company. One of the most obvious beneficiaries of higher oil prices is Petron Corporation. Petron is the largest oil refining and marketing company in the Philippines. It imports crude oil, refines it, and distributes petroleum products across a nationwide network of fuel stations and industrial clients, right? When oil prices move higher, refiners like Petron can sometimes benefit from stronger refining margins and inventory gains. If fuel demand remains stable while prices rise, companies that control refining and distribution can generate stronger revenue streams. For investors watching Petron, key indicators include refining spreads, fuel demand, and operating margins. Next is Shell Pilipinas Corporation. Shell Pilipinas operates one of the largest fuel retail networks in the country. Its stations sell gasoline, diesel, and other petroleum products to both consumers and commercial clients. Fuel retailers can benefit when oil prices trend higher because they operate within a pricing structure where retail prices adjust alongside global energy markets. In addition, companies with strong logistics and distribution networks can sometimes capture inventory gains during periods of rising prices. That makes large retailers like Shell Pilipinas an interesting company to watch in an environment where energy prices are moving upward. The third company may surprise some people. That is Manila Electric Company, also known as Meralco. At first glance, it might seem like a power distributor would suffer when oil prices rise, but Meralco operates under a regulated framework where generation costs are passed through to consumers. This means that when fuel costs rise globally, electricity prices often adjust higher as well. For Meralco, the company still earns a regulated return from distributing electricity to millions of customers across Metro Manila and surrounding provinces. Because electricity demand remains essential for households and businesses, utilities like Meralco can maintain stable cash flows even during periods of energy price volatility. Fourth on the list is Semirara Mining and Power. Semirara is the largest coal producer in the Philippines and also operates power generation facilities. Coal and oil are both major sources of energy. When oil prices rise significantly, alternative fuels like coal often become more attractive for electricity generation in certain markets. If demand for coal strengthens alongside higher global energy prices, companies like Semirara could benefit from higher selling prices and stronger revenues. Next, we have DMCI Holdings. DMCI is a diversified conglomerate with businesses spanning mining, construction, real estate, and energy. Because of its ownership stake in Semirara Mining and Power, DMCI has indirect exposure to the energy sector. That means if coal prices remain strong due to rising energy costs globally, DMCI's earnings could also benefit through its stake in the coal and power business. Conglomerates like DMCI often give investors exposure to multiple sectors, which can create resilience during volatile economic conditions. The sixth company is San Miguel Corporation. San Miguel is one of the largest and most diversified companies in the Philippines. It has major businesses in infrastructure, energy, fuel distribution, food, and beverages. Through its energy and infrastructure divisions, San Miguel has exposure to power generation and energy-related assets. Large diversified conglomerates can sometimes benefit during commodity cycles because certain segments perform better while others face higher costs. That diversification can create opportunities for stronger overall earnings when energy markets are moving. Seventh on the list is Aboitiz Equity Ventures. Aboitiz Equity Ventures is another large conglomerate with significant exposure to the power sector through its energy subsidiaries. Electricity demand in the Philippines continues to grow as the economy expands, and higher energy prices can influence power market dynamics. Companies with generation assets and strong infrastructure positions can sometimes benefit from stronger electricity pricing environments. Investors watching Aboitiz often monitor generation capacity, fuel mix, and power demand growth. 8 is ICTSI. ICTSI operates port terminals around the world and plays a major role in global shipping and logistics. Energy price increases often ripple through transportation and shipping costs. When shipping rates rise or logistics networks tighten, port operators can sometimes see increased revenues through higher throughput fees and service charges. Because ICTSI operates internationally, it benefits from global trade activity and shipping flows. 9th is San Miguel Food and Beverage. While food companies face higher input costs when energy prices rise, large integrated producers with strong distribution networks can often pass some of these costs to consumers. San Miguel Food and Beverage is one of the largest consumer companies in the Philippines with major brands in beer, food, and packaged goods. Scale and brand power can provide resilience during periods of inflation and rising commodity prices. And finally, the 10th company on the list is Metro Pacific Investments Corporation. Metro Pacific owns infrastructure assets including toll roads, water utilities, and transportation services. Infrastructure companies often operate under long-term concession agreements where pricing adjustments can occur over time. During periods of inflation or rising energy costs, infrastructure operators with regulated or indexed pricing structures may still maintain stable revenue growth. For investors, the key metrics to watch include tariff adjustments, traffic volumes, and long-term infrastructure demand. Now, it's important to emphasize something. Higher oil prices create both winners and losers in the economy. Transportation companies, airlines, and businesses with thin margins often face higher operating costs when fuel prices rise. But companies involved in energy production, distribution, infrastructure, and logistics may be able to adapt or even benefit. That's why understanding how energy prices flow through the economy is so important for investors. If oil prices remain elevated in the coming months, the companies we discussed today are some of the Philippine stocks that investors may want to watch closely. Of course, this video is not investment advice. Every investor should conduct their own research and consider their risk tolerance before making decisions. But understanding macro trends and like energy prices can help investors think more strategically about where opportunities might appear in the market. If you want a deeper breakdown of any of these companies, including their dividends, valuations, and long-term outlook, comment the ticker symbol below and I'll consider making a dedicated analysis video. And if you want more videos explaining how global trends affect the Philippine stock market, don't forget to like, subscribe, and share. Because in investing, sometimes the biggest opportunities come from understanding the forces moving the entire market.